Okay, so today we're gonna examine why the sterling weakened following a combination of political uncertainty in the UK and signals from the Bank of England. Although there was no single dramatic policy shift, markets reacted to build-up of concerns around leadership credibility and the future path of interest rates. This episode is useful for understanding how foreign exchange markets respond not just to economic data, but to expectations and perceived risk. So what actually happened here is that the sterling came under pressure because two things happened at the same time. First, there was renewed political uncertainty in the UK, which raised questions about stability, credibility, and overall direction of the country's leadership. Even when politics doesn't immediately affect the real economy, markets are very sensitive to the perception of risk. At the same time, signals from the Bank of England reinforced the idea that interest rates have likely peaked. Markets began to price in the possibility of rate cuts later on, which reduces the appeal of holding sterling compared to other currencies. When you combine um, political uncertainty with expectations of looser monetary policy, currency markets tend to react negatively. It's exactly what we saw here with investors reassessing sterling's near-term outlook. More broadly, this move is a good example of how foreign exchange markets work. Prices don't just reflect current economic data, but expectations, confidence, and how investors think risks might evolve in the future. So why did the sterling fall? Well, if the sterling fell as investors reassessed the relative attractiveness of UK assets in light of this uncertainty. Currency markets are highly forward-looking, meaning they price in potential risks before they show up in economic indicators. Political instability raises concerns about future policy consistency and long-term economic management. Even in the absence of immediate economic deterioration, these confidence effects alone can drive significant currency movements. Okay, so alongside the political developments, the Bank of England's latest decision and accompanying commentary played an important role. Although interest rates were not necessarily changed, the tone of communication suggested that policymakers are becoming more cautious and that rate cuts later in the year are increasingly likely. Lower expected interest rates reduce the appeal of holding sterling as investors compare returns across currencies. When combined with political uncertainty, this more dovish outlook intensified downward pressure on the pound. So some of the wider market implications. So the weakening of sterling has broader implications beyond the foreign exchange market. A lower pound can support exporters by improving price competitiveness abroad, which may help certain sectors of the economy. However, it also raises the cost of imports, increasing the risk of imported inflation and placing pressure on consumers. Bond and equity markets respond as investors adjust their expectations for growth, inflation, and interest rates, highlighting how currency movements, reflect wider shifts in investor sentiment. So to conclude, the sterling's decline was not driven by a single shock, but an accumulation of political uncertainty and changing monetary policy expectations. Uh, the episode highlights how sensitive the pound remains to leadership, credibility, and signals from the Bank of England. Looking ahead, markets will closely monitor political developments, economic data, and central bank communication to assess whether this weakness is temporary or part of a broader trend. Again, another fairly short video. Hope you guys have enjoyed. If you do, feel free to, I'd greatly appreciate it if you guys could like the video and subscribe, and also check out my TikTok page. Thank you.